Before you buy a single share of anything, here is the simple checklist that separates investing from gambling. Not a strategy, not a system, a checklist, and it takes about 20 minutes. Here is the difference between the two activities, and it is not the outcome. Two people can buy the identical share on the identical day, and one of them is investing, and the other is gambling. The difference is whether you can say what the company sells, whether it makes money doing it, and what you are paying for each dollar of that money. If you cannot, you are placing a bet. Quick disclaimer before we go further. This channel is educational. I am not a financial advisor. I do not know your situation, and nothing here is a recommendation to buy or sell any security. No real company is named anywhere in this video. Every figure is verified against a primary source and current as of recording. Check anything that matters with a professional you actually pay. No face, no courses, no biz. Nothing is sold to you here, no ticker is being pumped, and there is no watch list waiting in the description. For the worked example, we are going to use a company that does not exist. Invented financials, internally consistent, so you can follow every calculation without me implying you should buy anything. 5 checks. What the business actually does. Revenue, profit, debt, cash, and price. In that order, because the order matters more than most people realize. Then, the red flags. The specific things that should end the conversation regardless of how good everything else looks, and one of them is a single sentence in a filing. And then the part almost nobody puts in a beginner video. The odds. Since 1926, 4 out of every 7 American stocks have had lifetime returns below 1-month treasury bills. Not below the market, below cash. 4 out of 7. That is the base rate you are playing against. And you deserve to know it before you learn the checklist rather than after. Passing this checklist means not obviously broken. It does not mean good investment. Anyone who tells you a 20-minute checklist can identify a mispricing is selling you something. Meet Dale Kirchner, 63, retired last spring from a regional utility, and he has just rolled a 401k into an account where for the first time in his life, he can buy whatever he wants. His son-in-law Reggie has been talking about one particular company for 8 months. Dale does not want to buy it because of Reggie. He wants to know how to check it himself. Which brings us to step 0, and it comes before any number. Can you explain, in one sentence a 14-year-old would understand, what this company sells and who pays for it? 1 sentence. No jargon. No repeating the phrases from the company's own website. If the only description you can produce is the marketing language, you do not understand the business yet. A platform enabling next-generation solutions across the ecosystem is not a sentence. It is a fog. And fog is frequently deliberate, because a business that is easy to describe is easy to evaluate. So here is ours. Meridian Fastener Company makes industrial bolts, screws and clips, and sells them to equipment manufacturers who build them into machines. That is the sentence. Second question. Who pays, how often, and what happens if they stop? For Meridian, a few hundred manufacturers pay per order, repeatedly, because their machines need fasteners on every unit built. That leads directly to a number worth finding. Customer concentration. A company where one customer is 40% of revenue is not really a company, it is a contract with a countdown on it. Companies must disclose any customer above 10% of revenue in their annual filing. It is usually 1 sentence, buried, and it is among the most informative sentences in the entire document. Third question. And this one separates people who read from people who skim. What would have to happen for this business to stop working? Name the thing. The company will tell you, because it is legally required to. Every annual filing has a risk factors section, and it is the only part of the document written by lawyers trying to be pessimistic. Most of it is boilerplate that appears in every filing ever written. The useful trick is looking for the risks that are specific. Named customers, named regulations, named dependencies. Those were added for a reason. Dale spends 20 minutes on step 0 and gets 3 sentences out of it. what it sells, who pays, and what would break it. He has not looked at a single financial number yet. And if you cannot complete step 0, you are finished. No amount of ratio analysis rescues a company you cannot describe. That is not a limitation of the checklist, it is the checklist working. Now the numbers, and the first thing to establish is where you get them. Because the answer is not the app you are about to use. Brokerage apps and finance websites show you a summary. Summaries are computed by whoever built the site, using whichever definition they chose, updated whenever they chose to update it. The actual numbers live in documents the company files with the securities regulator under penalty of law, signed by executives who go to prison if they are knowingly false. The annual one is called a 10K, and its quarterly sibling is a 10Q. The annual document contains the full financial statements, the business description, the risk factors and management's own discussion of what happened during the year. They are all in the regulator's public database, which is searchable by company name. No account, no subscription, no data provider. It is one of the genuinely great free resources in American life. Now, a 10K is often 200 pages, and nobody expects you to read it. So here's what a beginner actually reads, and it is about 6 pages. First, the business description, what they sell and how. This is where you confirm your one-sentence answer and where you frequently discover it was wrong. Second, risk factors, skimmed for the specific ones. You are hunting for named things, not for the paragraph about how general economic conditions could adversely affect results. Third, management's discussion and analysis. This is management explaining their own numbers in prose. It is the most readable section, and it tells you what they think matters. Fourth, the 3 statements themselves. The income statement, which shows revenue and profit. The balance sheet, which shows what they own and owe. And the cash flow statement, which is the one that matters most. One reading tip that costs nothing. Compare how confident the language is in management's discussion against what the numbers actually did. A gap between the two is information. Dale finds Meridian's annual filing in about 90 seconds. He is not going to read 200 pages. He is going to read 6 and then run 5 checks on the numbers. Check 1 is revenue, which is simply the total money coming in from selling things before any costs at all. It is the top line of the income statement and the least ambiguous number in finance. You want 3 years minimum, because 1 year tells you nothing about direction. Meridian's last 3 years, $355 million, $386 million, $412 million. That is 8.7% growth, then 6.7%, compounding over the 2 years to 7.7% a year. Growing and decelerating slightly. Deceleration is not automatically bad. It is a question to hold. Is the market maturing? Did they lose a customer? Or was the earlier year unusually strong? The filing will usually tell you which. One benchmark that costs nothing. Compare revenue growth to inflation. A company growing revenue at 2% while prices rise 3% is shrinking in real terms while appearing to grow. Check 2 is profit, and here is where beginners get lost. Because there are 3 of them, and they are not interchangeable. Each one answers a different question. Gross profit is revenue minus the direct cost of making the thing. Meridian, $132 million on $412 million of revenue. That is a 32% gross margin. Gross margin tells you whether the product itself is any good as a product. 32 cents of every sales dollar survives the cost of the steel and the labor that shaped it. Operating income is what remains after running the whole business. Salaries, rent, sales teams, everything except interest and tax. $48 million, which is an 11.7% operating margin. That one tells you whether the company is well run. A good product with a bloated organization shows a healthy gross margin and a thin operating margin, and that gap is where you look. Net income is what is left after interest on the debt and after tax. $31 million, which is a 7.5% net margin. This is the number people mean when they say profit. 32, then 11.7, then 7.5. Read them as a sequence, and you can see exactly where the money goes at each stage, which no single number tells you. And as with revenue, the trend matters more than the level. Margins that are stable or rising suggest pricing power. Margins falling year after year suggest competition winning, and that is very hard to reverse. Do not compare margins across industries. A grocery chain running a 2% net margin can be excellent. A software company at 2% is in serious trouble. Compare a company to itself and to its direct competitors. So Meridian, revenue growing at a modest but real rate, margins in the range you would expect for industrial manufacturing, nothing alarming. 2 checks passed and no conclusions yet. Check 3 is debt, and this is the one that actually kills companies. Businesses very rarely die from low profits. They die from an obligation they could not meet on a specific date. Let me be clear that debt is not a red flag by itself. Borrowing to build a factory that earns more than the interest costs is exactly what a manufacturer should do. The question is proportion. The headline ratio is debt to equity. Total debt divided by shareholders' equity. Meridian carries $185 million of debt against $210 million of equity. That is 0.88. But debt to equity is not the ratio I would give a beginner. It compares a debt to a bookkeeping value. There is a better one that compares a debt to the company's actual ability to service it. Interest coverage. Operating income divided by interest expense. It answers one question. How many times over could this company pay its interest bill out of the profit it made this year? Meridian earned $48 million of operating income and owes $12 million of interest. 48 divided by 12 is 4. It could pay the interest bill 4 times over. As a rough scale, above 3 is comfortable, between 1.5 and 3 deserves attention, and below 1.5 is fragile. Below 1 means operating income does not cover the interest at all. A company with coverage below 1 is paying interest out of borrowings or reserves. That is a countdown, not a business model, and it is the single most useful number on this checklist. One thing coverage does not tell you: when the debt is due. A company with comfortable coverage today can be in serious trouble if a large amount matures next year at a higher rate. That schedule is in the notes to the financial statements, and it is worth the 30 seconds. Look for a big number due within 2 years relative to the cash they have on hand. The third debt-adjacent number is the current ratio. Current assets divided by current liabilities. Things convertible to cash within a year against things owed within a year. 168 million over 96 million is 1.75. It has $1.75 of near-term assets for every dollar of near-term obligations. Below 1 would mean a short-term squeeze. Meridian, 0.88, 4 times 1.75. Nothing that would stop a reasonable person. Check 3 passed and still no conclusion about whether to buy anything. Check 4 is the one that separates people who have read a financial statement from people who have read about financial statements. Profit and cash are not the same thing, and the gap is where the bodies are buried. Reported profit involves judgment. When to record a sale. How fast to depreciate a machine. What to assume about returns. Those judgments are legitimate, and they are also flexible. Cash arriving in the bank does not involve judgment. Either it came in or it did not. That is why the cash flow statement is the most honest document in the set. The number you want is at the top of it. Cash from operating activities. The actual money generated by running the business, before anything is spent on expansion or paid to lenders. Meridian's operating cash flow was $39 million against reported net income of $31 million. Cash exceeding reported profit is a good sign, and it is more common in healthy businesses than people expect. So the check is a comparison, not a level. Put operating cash flow next to net income for 3 years. If profit consistently exceeds cash by a wide margin, something needs explaining. Then subtract capital expenditure, which is money spent on equipment and facilities. 39 million minus 17 million of capex leaves 22 million of free cash flow. Free cash flow is the money genuinely available to pay down debt, buy back shares, pay dividends, or sit in the bank. It is the closest thing to what the business is actually worth to an owner. And here is a useful cross-check that combines two of our five. Meridian owes 185 million and generates 22 million of free cash a year. That is roughly 8.5 years to repay everything. Nobody repays all their debt from free cash flow. So treat it as a stress measure rather than a plan. Under 5 years is comfortable. Above 10 and the debt is starting to define the company. One nuance. Heavy capital spending is not automatically bad. A manufacturer building capacity may show weak free cash flow for 2 years and be much stronger afterwards. The distinguishing question is whether the spending is building something new or merely maintaining what exists. Management's discussion usually says which, and if it does not, that itself is worth noticing. Which brings us to the only check that has anything to do with whether you should buy it. Every number so far described the company. The last one describes what you are being asked to pay. Check 5 is price, and I want to start with the distinction that everything else in this section depends on. The price of a share and the value of a company are different things. Meridian trades at $28.50 a share. That number on its own tells you absolutely nothing. Not whether it is expensive, not whether it is cheap, not how big the company is. A company can split its shares tomorrow and have the price without anything changing. Share price is a fraction of a business divided by an arbitrary number of pieces. The number that means something is market capitalization. Price times the number of shares. 2850 times 24.5 million shares is $698 million. 698 million is what the market says the whole company is worth. That is the figure to compare against anything, and it is the one beginners consistently skip. Now connect price to profit. Earnings per share is net income divided by shares outstanding. 31 million divided by 24.5 million shares is $1.27 per share. The price to earnings ratio is the share price divided by earnings per share. 2850 divided by 127 is 22.5. And here is the plain English meaning that almost nobody states. You are paying $22.50 for every $1 of annual profit. That is what the number is. Said another way, at the current rate of earnings, it would take the company 22.5 years of profit to equal what you paid. That framing makes a PE of 90 feel different. Flip it over and you get the earnings yield. 1 divided by 22.5 is 4.4%. That is your share of profit as a percentage of what you paid, which lets you compare a stock to something else for the first time. 4.4% against whatever a government bond pays. That comparison is the beginning of thinking about price properly. Some reference points. A PE of 10 is a 10% earnings yield. 15 is 6.7. 25 is 4. 50 is 2%. 100 is 1%. Now the part where I am going to disappoint you. There is no PE number that means cheap. I am not withholding it. It genuinely does not exist, and every rule of thumb you have heard is wrong somewhere important. A low PE frequently means the market expects earnings to fall. You are not buying $1 of profit cheaply. You are buying $1 of profit that is about to become 60 cents. A high PE means the market expects growth. Sometimes that expectation is correct and the stock is fairly priced. Sometimes it is wrong. The PE cannot tell you which, and neither can I. So what is it for? Comparison against the same company's own history and against direct competitors doing the same thing. A company at 40 when its 3 closest peers are at 18 is a question worth asking. One trap. Websites show trailing and forward PE without always labeling which. Trailing uses the last 12 months of actual reported earnings. Forward uses analyst forecasts, which are opinions about the future. Use trailing. Everything in this video uses trailing. Forecasts of earnings have a long documented history of being too optimistic, and building a purchase on a forecast is building on somebody's hope. Before the red flags, one piece of context that changes how you should read any individual PE, and it is genuinely important as of the moment this is being recorded. The market as a whole has a price-to-earnings ratio, because you can add up the prices and add up the earnings. And there is a smarter version of it that a Yale economist popularized decades ago. Instead of 1 year of earnings, it uses the average of the last 10 years, adjusted for inflation. That smooths out booms and recessions, which is exactly when a plain PE becomes misleading. In 2009, the market's plain PE spiked enormously, not because stocks were expensive, but because earnings briefly collapsed. The 10-year version saw through it. That is why it exists. As of August 2026, that 10-year measure was reading somewhere between roughly 40 and 42, depending on the provider and the day. The long-run median across 1,748 monthly readings going back to 1881 is around 16.6, so the current level is roughly 2.5 times the historical middle. It sits at about the 98.9 percentile of everything ever recorded. The all-time high was 44.2 in December 1999. The market's plain trailing PE was around 26 at the same time. And here is something worth showing you, because it teaches a habit. In that same month, different providers published 40.4, 41.2, 41.58, and 41.96. None of them is wrong. They updated on different days and used slightly different earnings inputs. Whenever a number seems authoritative, check who computed it and when, because there is rarely one true figure. Now, the honest reading of what this means, because it gets abused in both directions. High starting valuations have historically been followed by below-average returns over the following 10 years and longer. It has essentially no power to predict the next year. It is not a crash signal, and anyone using it as one has been wrong for a long time. It changes long-horizon expectations, not next quarter. So the practical implication for Dale is not to sell everything or to stop investing. It is to hold more modest expectations for the next decade than the last one delivered, and to keep contributing anyway. And for our purposes, it means a PE of 22.5 on one industrial company sits below the broad market's plain reading, which is a data point rather than a verdict. Now the red flags. And to show them properly, here is a second fictional company with the identical revenue to Meridian and completely different insides. Red flag 1. It reports $31 million of net income, exactly like Meridian. Its operating cash flow is $9 million, a $22 million gap between the profit it claims and the cash it collected. There are innocent explanations. Rapid growth ties up cash in inventory and unpaid customer invoices. But when the gap persists for 3 years and widens, the profit is a bookkeeping outcome, not a banking one. So this is the single comparison I would run before any other. 3 years of net income beside 3 years of operating cash flow. If they diverge and keep diverging, stop and find out why. Red flag 2 is the quietest one on this list, and the one beginners almost never check. Share count. This company had 21 million shares 3 years ago. It now has 24.5 million. That is 16.7% more shares in existence. Nobody announced it. There was no bad news. The company simply issued more pieces of itself, usually to raise money or to pay staff. If you owned a share 3 years ago, your slice of that company shrank by 14.3%, and nothing about the business changed. You were quietly diluted. Watch what it does to the number people watch. With net income flat at 31 million, earnings per share went from $1.48 to $1.27, a 14% decline with no operational cause. Share count is on the cover page of the annual filing and in the income statement. Check it every year. Rising steadily and substantially is a transfer of ownership from you to somebody else. Red flag 3. Our second company has $340 million of debt against $110 million of equity, a ratio of 3.09, and operating income of $22 million against interest of 26. Coverage of 0.85. It earned 85 cents of operating profit for every dollar of interest owed. It is not paying its interest from operations. It is paying it from somewhere else. For a beginner, that is the end of the analysis. Whatever else is true about the company, coverage below 1 means the clock is running, and you do not need to be the person who works out how long. Red flag 4 is not a number. It is a phrase. If the auditors have expressed substantial doubt about the company's ability to continue as a going concern, that appears in the filing in plain English. Going concern means the professionals who examine the books are formally uncertain the business survives the next 12 months. Search the document for that phrase before anything else. It takes 4 seconds. Red flag 5. Restatements of previously reported results, or an auditor resigning or being replaced without a mundane explanation. Both mean somebody who looked closely was unhappy. Red flag 6. Accounts you cannot follow. If a manufacturer's financial statements require an unusual amount of explanation, the complexity is doing work, and it is rarely working for you. These are disqualifiers, not judgments about the people running the company. Plenty of honest businesses hit hard periods. The point is that a beginner is not equipped to distinguish a hard period from a terminal one. So Dale has run the checklist. He can describe the business, revenue grows, margins hold, debt is serviceable, cash exceeds profit, and the price is not obviously absurd. Now the uncomfortable part. None of that means he should buy it. The checklist eliminates disasters. It does not identify winners, and I want to show you the evidence for why that gap is so much wider than it feels. A finance professor took every American common stock in the standard academic database going back to 1926, roughly 25,000 companies, and computed what each one returned over its entire lifetime. 4 out of every 7 had lifetime buy and hold returns lower than 1-month Treasury bills, not lower than the market, lower than the safest short-term cash instrument that exists. The median stock's lifetime return was negative, around minus 3.7%. The typical stock, over its whole life as a public company, lost its owner's money. So where did the market's enormous historical return come from? The best performing 1,092 companies, slightly more than 4% of the total, account for all of the net wealth creation. And I want to state the rest precisely, because it is constantly misquoted. The other 96% did not all lose money. Collectively, in aggregate dollar terms, they matched 1-month Treasury bills. It gets narrower. The 90 top performing companies, about 1/3 of 1% of the total, account for over half of all the wealth ever created by the American stock market. This is not an American quirk. Across more than 64,000 global stocks, from 1991 to 2020, 55% of U.S. stocks and 57% of non-U.S. stocks underperformed Treasury bills. The same researcher ran a simulation. Pick one stock at random and hold it. Repeated many times over 90 years, the single stock strategy underperformed the market in 96% of the runs, and it underperformed 1-month Treasury bills in 73% of them. Those are the base rates. That is the game you are entering when you buy one company. Now the people who do this full-time, with teams and terminals and access to management. In 2025, 79% of active large-cap U.S. equity funds underperformed the index. That was an unusually bad year, so use the durable figures instead. Fewer than 1 in 6 active managers beat the index over 10 years. Over the 15 years to December 2024, not one of 22 U.S. equity categories had a majority of managers outperform, and the ones who do win rarely repeat. Among funds in the top half of their category in 2021, only a handful stayed in the top half over the next 4 years. For large cap funds, the result was worse than random chance. Sit with that phrase. Past outperformance predicted future outperformance slightly worse than a coin would have. That is what the scorekeeper's own data says about identifying skill in advance. This is the entire argument for a broad, low-cost index fund. And it is not that index funds are clever. It is that owning everything guarantees you own the 4% that produced all the gains. Stock picking is an attempt to find that 4%. Indexing is a refusal to try, which mathematically means you cannot miss them. Given the base rates, refusing to try is the stronger position for almost everyone. In fairness, the index approach has real drawbacks, and they should be said out loud. You own the bad companies too. You get the full drawdown in every crash with no defensive option. And a broad index today carries a large weight in a small number of very big companies. So an investor who believes they are overvalued is buying more of them by construction, not less. So does a single stock ever make sense? Yes, in a narrow set of circumstances, and I would rather define them clearly than pretend the answer is never. First, when you genuinely know something structural about an industry from working in it for decades. Not a tip, not a feeling. A working understanding of who is actually good at something and why, with an enormous caution. Knowing an industry is not the same as knowing whether a share price already reflects what you know. Most industry expertise is already in the price, and material non-public information is illegal to trade on. Second, a deliberately small position taken to learn. Owning one company changes how you read a filing, and that education is real and difficult to get any other way. The rule that makes this safe is size. On a $250,000 portfolio, a 5% position is $12,500. If it fell by half, you would lose 2.5% of everything. That is survivable. A 10% position halving costs 5% of the whole. A 30% position is not a learning exercise. It is a bet on which your retirement date depends. Third, some retirees hold individual dividend payers for income they can predict. That is a legitimate reason, though it concentrates risk in a way a broad fund does not, and dividends can be cut. And the reverse case, which matters more for this audience than any of the above. Company stock from your own employer. Your salary, your pension, and your investment already depend on one organization. That is a concentration most people never consciously chose, and it is the single most common serious portfolio error among long-tenured employees. If you are holding a large block of it, that is worth examining. The structure most sensible people land on is boring. A broad, low-cost index fund as the core, and a small satellite for individual holdings if you want them, with the satellite size so it cannot hurt you. I am not naming a fund, and I am not going to. Broad and low cost describes a category, and which one is right depends on your account, your taxes, and your situation, none of which I know. Dale ran the checklist on Reggie's company. It failed on share count, which had risen 19% in 3 years, and on the gap between reported profit and operating cash flow. He did not buy it. He also did not have an argument with his son-in-law about it, because he had a reason rather than an opinion, and reasons are much easier to say out loud. So here it is assembled, in order. Print it, write it down, keep it somewhere. It works on any company, and it takes about 20 minutes once you have done it twice. Step 0. Say in one sentence what the company sells and who pays for it. Then name the thing that would break it. If you cannot do this, stop. Nothing below rescues it. Check 1. Revenue. 3 years minimum. Is it growing? And is it growing faster than inflation? Deceleration is a question, not a verdict. Check 2. Profit, gross margin, operating margin, net margin. Read as a sequence. The trend across 3 years matters more than the level. Compare only against the same company and direct competitors. Check 3. Debt. Interest coverage first. Operating income divided by interest expense. Above 3 is comfortable, below 1 and you are finished. Then debt to equity and the current ratio. Check 4. Cash. Operating cash flow against net income for 3 years. If profit persistently exceeds cash, find out why. Then subtract capital expenditure to get free cash flow. Check 5. Price, market cap, not share price. Then the PE, and remember what it literally means, which is how many dollars you pay per dollar of annual profit. Use trailing, not forward. The 6 red flags. Profit without cash. Rising share count. Coverage below 1. Going concern language. Restatements or auditor turnover. Accounts you cannot follow. Everything is in the annual filing, free, in the regulator's public database. 6 pages of a 200-page document. Business description, risk factors, management's discussion, and the 3 statements. And the limit, 1 final time. Passing this checklist means not obviously broken. It does not mean good investment, and no 20-minute process will ever mean that. 4 out of 7 stocks have historically returned less than cash over their lifetimes. 4% of companies produced all the gains. That is the environment the checklist operates in. Which is why, for almost everybody, the honest conclusion is that the broad low-cost fund does the heavy lifting and individual stocks stay small enough that being wrong costs you a number you can name. So, investing versus gambling. It was never about the outcome, and it was never about how much research you did. It is about whether you can state your reasons before you press the button. 3 sentences about the business. 5 numbers about its health. 6 things that end the conversation. That is the whole method, and it costs you 20 minutes and no money at all. The filings are free, permanently, to everyone. The information gap between you and a professional is much smaller than the marketing around investing wants you to believe. What is not smaller is the odds. Most individual stocks have historically returned less than cash. Owning everything is the only way to guarantee you own the handful that mattered. So the checklist's real value may not be finding you a stock. It may be the number of times it stops you, calmly and with a reason, from buying something somebody was enthusiastic about. No face, no courses, no bees, and no ticker sold to you at any point. See you tomorrow.